Okay, good afternoon, everybody. This is your weekly take on the market. Today is August 5th, 2022. The market has just closed about a half hour ago. I will be your host. See if I can navigate this. All right, technical difficulties already. So my name is Scott St. Clair. I'm the Premium Product Group Manager here at Investors Business Daily. Here is a disclaimer slide. Take a moment to read it. We're not licensed at IBD. We don't make buy, sell, hold recommendations. Really try to stay in our sweet spot, which is education and research, providing tools for you guys to make your own decisions. We'll start with the market indices, industry groups, some stocks to watch, and then we'll do the quote of the week. So let me pull up my MarketSmith. And you should see a chart of the NASDAQ, pretty much up to date price wise. I don't know what the volume was like today. We had jobs report, and so the market tried to open lower, rallied, then it ended up going lower again, and then by the end of the day it rallied. So it closed actually pretty good, actually a pretty good close, considering down 0.5% on the news of the the really strong jobs number, which implies that the Fed is not done hiking rates. I think the bond market, saw it that way. The long bond, just TLT, was down 2%. So I don't know. I think the market actually held up pretty well, considering the news. It's not the news; it's a reaction to the news. You really want to understand if the market can shake off bad news. If it's perceived as bad, that's a really, really bullish sign. Same with the S&P, practically unchanged, nice low bar. And, the market's just meandering higher. Who knows where the next stop is? It seems like, it's probably going to want to test this 200-day. That'll get a little bit lower. Just somewhere along the way, it seems likely that that's the test. I don't know if the lows are in, and honestly, I don't need to know. I don't care. I'm just going to play the market as we stand here now. And it's not a market that I think, anyways, I'm going to be wildly bullish in, but I think I want to be participating. I have some longs. I do have a single short, just as kind of a feel, a probe. If I start to make money on the short side, and I've considered a couple of other shorts, but if I start to make money there, then that would give me feedback that maybe the market, is turning. But I just don't think you need to be in any hurry. Let's go to the slideshow. Because, if this is real, if this is the low, there'll be plenty of time to make money. So this is a screenshot that I did for a webinar, and it's the NASDAQ on September 3rd, 2020, after the follow-through day of the COVID crisis. Now, this is a very unusual market, super, super strong, but you had the follow-through day, and on the follow-through day, DocuSign broke out. And then a couple of days later, NVIDIA and Livongo broke out. Livongo eventually got bought out by Teladoc. And then a few days later, Dexcom. A few days later, Amazon, Okta, Zscaler, C Limited, Shopify, Etsy, Adobe. These are all breaking out like weeks after the follow-through day. Apple, Bandwidth, Melly, PayPal, Coupa, Software, Datadog, Tesla. Look where Tesla broke out, way past the follow-through day. Deer, CrowdStrike was kind of last name. Net was a huge winner. And there's plenty of others that, I didn't put in the slide. But the main theme is if this is real, if it's a real low, stocks will start building bases or push up that right side. They'll start breaking out, and you'll have a lot of runway, because we've had a nasty bear market. So there's a lot of potential runway if this is a real low. And if it isn't, you just, you'll stop out of some of the things you buy, and you'll, wait it out and, rinse and repeat for the next move. So I know we all have this, feeling like we want to, is today a follow through day, or, is today a follow through day? Should I be buying today? And you probably want to do something. I think you definitely want to do something on a follow through day if you're 100% cash. But if you're not, if you're already 20% invested or 30% invested, I don't think you have to do anything. You already have, let's say you have a couple of names that you're trying to ride through bases on. So there'll be a lot of opportunity. You're not going to kiss all the babies. I know I didn't buy all of these. I think I had Docu. I definitely had LVGO, Zscaler, C Limited was one of my best ones. I did not have Etsy. I had Shopify for half a minute. I did not have Apple Band. I did not have Melly. I had PayPal. I did not have Coop. Datadog, I don't remember making big money in that one. I totally whiffed on Tesla. I had Net, but sold it too soon. That was a huge winner. So, a lot of these I mishandled and or didn't handle at all, and made 100% plus in cash accounts in my IRAs in 2020. 2020 is a very unusual year. I'd love to have 2020 back. So, that you don't take so much out of that, but that doesn't mean you can't, the next one, you can't do really well if there's half the number of names that, 2020 might've had. Next slide. So this is interesting. I like this slide. It's, from Ned Davis Research, I believe. I better get this right. Yeah, NDR. And if S&P following 18% declines, recession versus no recession. So if we don't have a recession, then, there's the black line, and you're looking at, a rally. The low might be in. If we do have a recession based on, previous markets, then you've had, kind of a bear market rally, and you're going to head lower and probably undercut the lows and go sideways for a long time. I guess the jury's still out, right? And there's all this talk about how they're going to define a recession or not. I think you'll know if it's a recession, right? It will really feel like a recession. It'll feel bad if it's going to go a lot lower. So I think the key here is anything can happen. If the market, the economy kind of finds its footing, finds its way out of this, then, maybe the lows are in. If we don't find our way out of it, then it's likely that we test those lows and or undercut those lows. And I don't know what the probabilities of either are, but I know they're not zero either way. So, invest accordingly, be open-minded to, either possibility. The other possibility is maybe the market, just goes sideways for a long, long time. And here's the Nikkei 225, which is kind of the Dow Jones of Japan. You can see the really amazing bull market that it had from, 50 to 1990. I think it topped in 89. And then it just has gone sideways forever, pretty much. You're looking at 40 years roughly of sideways action. But there's been a huge number of, stops and starts along the way, rallies and pullbacks and rallies and pullbacks. And here's all the pullbacks from the high to 1990, down 28% in 3 months, up 18% in 2 months, down 39% 4 months. So, you don't have to, can be pretty, pretty busy, but that's the idea. There could just be a lot of stops and starts along the way. And so, it might be times for you to be invested and times for you to be on the sidelines, and just be flexible to that. But even if it's a long, long time of sideways, there could be some tradable rallies where you could make money in some names, if you, and I bet some of you have in this last, kind of move that we've had. I think the semiconductor index has made a big move off the lows. The indexes are all double digits off the lows. So there's been some money to be made. So here's the S&P in 1982. And, if you bought it in 1965, I'm not going to include dividends. You pretty much by 1982 were even up a little bit, but you can see a lot of stops and starts along the way. But these are all, for lack of a better term, I'm not a big fan of this tradable rally term, but, goes from 72 to 109 over, this is a monthly chart, right? Over, 15 months, goes from 68 to 120 over 20 months, goes from 60 to 108 over 20 months, 86 to 141 over 40 months. So these are areas where if you have the right stock selection criteria, you've got, you're timing your buys, maybe there's some rotation, the money's going to go somewhere. It just doesn't disappear. I know rates have gone up, but it's not going to all flood into bonds or money markets. So you can find some areas. So stay engaged, look for it. Don't assume the market's going to do anything. And even if it goes sideways like the Nikkei or sideways like this for a long, long time, I think you have plenty of chances to make some money along the way. AAII sentiment numbers, they're finally getting more bullish. Remember, sentiment follows price, not the other way around. So as the market goes up, they'll get more and more bullish. As the market went down, they got more and more bearish, and they got super bearish near the lows. The problem was they were getting really bearish for a number of weeks before the lows came in. I was listening to Charles Harris on a Twitter space yesterday, and I know Charles, who's portfolio manager, William O'Neill, uses sentiment to try to gauge, his buys and sells. And, he's pretty forthright, said he's not having a great year. And he feels like one of the reasons was he's just relied too much on the sentiment. Felt like sentiment was very bearish. He'd get in and then the markets would make new lows. It's a secondary indicator, something to consider. I always look for it, like if I'm doing well and I'm on one side of the fence and everybody else seems to be on that side of the fence, then I know that, a shakeout's coming, or if I'm short, a big rally is coming. I just don't know when. And so I want to be prepared for it and just know that it's out there. It's out there. It's just a matter of when, not if. All right, so let's jump into MarketSmith and let's go to the industry groups. So weekly review, 197 industry groups. I haven't been in today, so I'm gonna have to resort this. Industry group rank last week. Oops, I want this one. Industry group rank. And then I'm gonna resort it. So the very first group is on top. Very first group is energy solar. There's been some good stocks in there, although SolarEdge did gap down on earnings. Oil and gas royalty trust, kind of a small group. Media periodicals, small. Retail supermarkets, pretty small. Biotech, very interesting. 803, 800 stocks. So there's a lot of stocks in that group. Now, our groups are not equally weighted, so not all 800 have a 0.5% or 0.2% weighting. We give the larger companies a bigger weighting. So Tesla would be a much bigger weighting of the auto manufacturers index than, say, NIO or Li Auto. So that's the same way with biotech, but you can see that biotechs actually have done pretty good. And XBI, oops, terrible typer. XBI looks really good. So it's kind of breaking out of this little shelf / flat base right there. You could have, if you were interested there. So interesting XBI. There's the weekly chart. So this is, potential idea that I've been interested in because of that strength in biotech. Problem with biotech is, you're subject to news. I think as a GBT, the news is that XYZ is interested in buying them out. and you get moves like this, but it can work in reverse. So that's why I think for me, I'm not a big user of ETFs on the long side. I prefer to be in stocks, but for biotech, I don't mind it so much because then I don't have that single stock risk is pretty severe in biotech. If I own XBI and XYZ is 5% of XBI and it gaps down 30% on some kind of bad drug news or something, it's what, let's just say 1% down tops for XBI, something like that. It just doesn't hurt you as much. You might not make as much either. When GBT does what it did, I don't know if GBT is in XBI, maybe, but you're not going to make as much in XBI as GBT. That's okay, right? It's just, a risk reward setup. So those are the groups: telecom infrastructure, starting telecom, fiber optics, Clearfield. So the groups actually look a little bit better, more growthy than they have in quite a while. And besides oil and gas royalty trust, you've kind of lost the energy area a little bit. They're much further down. Pipeline. So that's pretty interesting too, although I'm not including solar, right? Solar is kind of a different one. So let's go to stocks to watch. So was it DGII? Computer networking, really good earnings report, jumped up big on that earnings report. This looks more like a cup with handle to me. So the buy point is really right there. It just poked its head. That's one thing about the pattern rec. It can't, doesn't have any flexibility. Like it just poked its head barely above 25.60 and then built this handle. So to me, this was the breakout, and it's done really, really, really well. Pretty small, 240,000. I don't own it. That's probably why it didn't really show up on my radar because of that. What else is out there? Oh, Enphase. Now, this is a really tough stock. The bars, I think I might have talked about this, but the bars are just so large on Enphase, it makes it really tough. But when it gaps up on earnings like that and really holds most of the move, that's a pretty good sign. And then you had, the infrastructure news. SolarEdge didn't work. Let's see some of the ancillary names like SunPower. It's okay. What about CSIQ? It's okay. SHLS. It's just okay. You got earnings in 10 days. I've moved on only because of the earnings in 10 days. And the bars are just, again, I don't like really large bars. I like things to just kind of trade a little bit more fluidly. It's not as, you don't have that quite like you used to in the old days. LNTH, just a wild Mr. Toad's ride this week on earnings, but looks very good. And the earnings were super strong, up 700%, revenue up 121. But you could see on the earnings, it tried to open higher, then it went lower, and then today had a really good day. So there's some stuff. PBR looks okay to me in the energy sector. It's building this. I don't know if I'd call that quite a handle, but maybe it's 2, 4, 5 days. Looks a little bit like a cup with handle. And what else is out there that let's go to the big boys. So let's look at Apple, just meandering higher, acting really good. The earnings, not all that exciting, but you know what? The stock is, I think the RS line is a new high while it's building the base. So hard to argue with that. Amazon. Now, this looks a little worse to me than Apple. This looks like a short potentially in here, but I'm not interested in shorting it. I feel like it's swimming upstream a little bit against the market at this very time. But fast forward a week, 3 weeks, 6 weeks, who knows? Microsoft, So heading that way, but it looks a little more constructive. It looks okay. I would just call it neutral. What about Google? Now, really underperforming, but I don't know if I'd want to short something like Google, right? I just don't see the upside to shorting something. I'd rather just short the index, short the QQQ and call it a day. And then NVIDIA. So yeah, it's just not, this doesn't quite have the umph that it once had. It's, you know, it's trying, but it's kind of lost a little bit of its mojo. I'd be curious, and this is probably a good thing we can do. Here's SMH. See, look at that number of weeks up in a row. And I think at last I calculated like 35% off the low. About 30%, not quite 35%, but let's do this. Let's add a custom RS. So let's go to the wrench. Let's choose relative strength line. We're going to add a line, and I'm going to add SMH. It's going to be green. I'm going to apply the changes. Let's go to the weekly so you can see a little bit better. And so there's this green line is the relative strength line of NVIDIA versus SMH. And you can see how NVIDIA normally outperforms SMH, right? I imagine it's a big part of that as well. So it should, but it's really kind of gone sideways. I know it's hard to see with some of these other indicators in there. Let me see if I can clean this up a little bit. I can't remove the original. Let's get rid of the moving average as well. Might clean it up a little bit. So it's just not performing it like the SMH has. Let's go to open up this panel over here. Let's go to my custom one. Scroll down. And the 3-month RS for SMH is 49. Let's see what the 3-month RS for NVIDIA is. It's 86. The 6-month is 42. Let's go to SMH. 6-month is 79. So it's very short term as far as the outperformance of SMH versus NVIDIA, but something to consider if you're, wanting to go back to some of these old names, because the old names are very tempting. It's tempting to want to go back to a PayPal or a UPST, because when they go, you can't even see this, but this is like 35% off the low. And me and Arusha were talking is like a firm is over 100% off the low, and it looks like nothing on the chart. It's something that I'd love to add if I go to the weekly. So it tells me it's 81% off the 52-week high. I wish we'd have, I think I'd like to take this and do a percentage off 52-week low. I think that'd be a good ad. You don't need to email me and tell me that you like that ad as well. I'm going to assume that everyone would like that. But it's just a matter of bandwidth and other projects that are in front of that. But that's something that I think would be a value add is, off the low as well. So your firm's over 100% off the low and just totally beaten up. The other things is, you had kind of the HKD, which is just bananas. It's IPOs at 7 and runs to 2000. It makes the corner in Northern Pacific look like a day at the beach back in the Livermore days. This is just if you don't know what a corner is, the market makers, the guys out there that can short this are shorting this, and somebody's buying it, and there's no supply, and they can't cover their shorts, and they're just getting run over. This is actually how would I word this? I don't like this type of thing happening. To me, if this is a true low, there should be some disgust with stock. There should be some disdain with the stock market. I want people to swear off the stock market forever. I remember what it was like in '09. It just felt like that we were never going to have another, big bull market. Like it felt like, oh my gosh, this is what am I going to do? I'm never going to make any money in stocks anymore. It's over. The game's over. That's how lows are made when you feel like that. And this type of action, just has me on pause a little bit. MEGL, which is in the same group, Hong Kong-based financial services. It was a $4 IPO. I'm not exaggerating. $4, opened it wherever, ran up to 2-something, 235. It's just kind of weird action. AMC had a really bad report. They're going to raise money, and the stock went up. Now, I'll be the first to say that it's not the news, it's the reaction to the news. But I really want to see, as weird as it sounds, these stocks just kind of go away and just, come on down and just kind of flatline for a long, long time. That would tell me that the speculation has just been kind of pulled out of this thing for good. I think Beyond had a really lousy report, and the stock was up 21%. So that's one negative that I see out there. The action in the market looks pretty good to me, but this gives me a little bit of pause as far as being aggressive to the long side. As strange as it sounds, you'd think it'd be the opposite, right? Stocks going up a lot. It's the types of stocks, and it's the types of moves that are not sustainable. If Apple and Google and Microsoft are going up really well, they'll never go up like this, of course, not in this stage of their life cycle, but that's fine. That's good, healthy action. But these low speculative mania type stocks doing this, not good action. You really want them to kind of be dead on the vine. All right, let's go to the quote of the week. And it's from Jason Shapiro. He was featured in the book New Market Wizards by Jack Schwager. I love the Market Wizards books. Those are great reads. He was on a podcast, and somebody asked him about how he handles different types of trades. If it's a high conviction trade, is it different than a low conviction trade, et cetera? And he had a great response. There's no such thing as a high conviction trade or as high conviction on a trade for me. I really like that. I think sometimes I weight my buys based on how much conviction I have, and I might own a little bit more, and I might be more reluctant to stop out of the high conviction trades. And that's the wrong thing to do. So this is perfect. There's no such thing. Every trade is exactly the same. You never know which ones are going to be your big winners. And there's no such thing as not having a stop loss. You have to have a stop loss. I know Kathy Wood was in Coinbase. There, I guess allegedly her average price for ARK was 245, and she got out at 50. And then the thing doubled, right? And so that's what keeps us in, right? Hoping for these miracle, Hail Marys at the end. Well, it doubled to 90. She still owned it at 245. So I don't know if she can have a stop loss of 5 to 8%, but I don't see any reason why she can't have a stop loss of 20%, or maybe a stop loss of 10% on a quarter of the position. A stop loss of 15 of another quarter at 15%, another quarter at 25%, something like that. I think you always should have some type of plan where your something is, hey, I'm wrong, even if it's only temporary, because you can always get back in, and it will keep you from. We've all learned in this environment, stocks can go down a lot. Yeah, in 2020, we all learned that stocks can go up a lot. And in 2022, we're all learning that stocks can go down a lot. And, even PayPal, I think when I did the math, I couldn't believe it. It was down 80 some percent at one point at the lows. PayPal, it just seems like such a stalwart, but it's down 80 some percent. So they can all go down a lot. So no high conviction trades. The more the stock goes up, the bigger the profit you have, the more I think you've earned the right to hold it if you want to. So you can have conviction at that point and just, be willing to give up the gains or some of the gains. But if you're up 200, 300, 400% on something, I still think you should have some type of plan to get out. Because if you pull up Shopify or PayPal or Square, there's a lot of stocks that, you'll be hard pressed to find a spot on the chart that you could have bought that and withstood the move down. And a lot of people, a lot of funds, a lot of hedge funds, a lot of mutual funds have given back huge gains in some of those names. So no high conviction trades, have a stop loss. If you don't want to use 5 to 8%, it's fine. If you have smaller position sizes, you want to give the stock more room to breathe, no problem. It's 10%, 15%, something. I know maybe half and half is a great way to do it. I sometimes do that, and I'll sell half down 5% and the other half down 10. So maybe I only get stopped out of half and I can keep the other half. Or if I get stopped completely, my average stop is 7.5%, which was going to be my max stop anyways. If you have, regret, you're having a hard time pulling the trigger, making an all or none decision on a stop. All right, the contact information, marcussmith@investors.com, 800-424-9033, our Marcus Smith Twitter, and then my own personal Marcus Smith. Thanks a lot, everybody. Have a great weekend, and we will see you next week. Bye-bye.